Clearly, as Romaine was showing us, distressed debt is piling up right now. With the economy slowing down, how much of the distressed debt do you think will be concentrated in the retail and consumer space over the next year or so?
Well, frankly, everybody's pretty leveraged. It's really interesting. You know, coming in COVID, everybody layered up, right? Because they wanted to have enough cash because they didn't know where the economy was going. But as they came out, we found that much of that debt didn't go away in that sector. You know, there have been a lot of long shots placed on brand companies that have rolled up brands and are trying to do all sorts of licensing. We've seen a number of them hit distress levels, as well as the continuing fallout in retail. You know, the bottom sector of retail is just, you know, every one of those companies are on the edge of, you know, not being with us anymore. Consumer has no patience. We talked about COVID from a retail perspective being the great awakening. Yeah. When the customer found that they could get anything they wanted delivered, you know, and so coming out of that, you know, if you didn't have a great online presence, if you didn't have an ability to do buy online, pick up in store, or what we call BOPUS, or any of those other ways that consumers can get products when they want them, how they want them, you're going to fall behind. And so we're going to see another pretty significant shakeout going into this next 12 to 18 month period.
And of course, a lot of that debt can't be rolled over given how credit conditions are tightening. Do you see us headed for a credit crunch in the next 6 months?
Well, you know, it's interesting. When you do these asset-based syndicated facilities, the syndication partners, I mean, obviously your agents are your big banks. You know, they're B of A, they're Wells, they're JP Morgan, the big players in the retail space. So Citi does some as well. But then the participants, so many of them are regionals. And so those regionals are not going to necessarily participate in as much of this if they're feeling uncomfortable with what their positioning is. And so some of that syndication is going to get heightened terms in order to be able to attract the participants.
But have we reached a point, though, where the terms, or at least the potential terms, is just going to be too onerous, I think, for some folks to swallow?
I don't think people are going to have a lot of choice.
Really?
Well, if you need the debt, right? You know, if you need the money, So,
well, sorry.
Are you talking about a consumer? Or are you talking about a retailer?
Well, I'm talking about the companies because I mean I don't mean to quibble, but when we say choice, I mean some of these companies, the choice is what? Either you take on debt that's so onerous that, or refinancing that's so onerous that you'll probably end up going out of business, maybe somewhere down the road, or you go out of business today.
Right. Right, or you figure out a way to restructure. Okay. You know, what we always say to the retailers is, you don't wait till you're out of liquidity to do something.
But you've been doing this for so long, right? And I think about sort of the
past.
Well,
I started when I was 12, so.
Fair enough. Past cycles, you were a child prodigy. But past cycles, it was just so much a different environment, retail environment, right? The internet wasn't a thing, or at least it didn't have the mighty presence that it has now here. Some of the companies that you've dealt with in the past, I just wonder how they would even hold up in this environment. Like if you don't already have that edge against the online retailers or the omni-channel retailers, what future do you have?
Well, you know, if you can figure out a way to leverage up and actually use that boatload of cash to accelerate yourself in that area, you actually have a chance. Okay. That's if you have a customer and if you have an offering that's differentiated. You know, if you're just a me too, if you're a customer's third or fourth choice in your segment, you're probably not going to survive. But if you're in that 2 to 3 position, you got half a chance as long as you're not completely out of liquidity and you've got some room to actually raise some money to make those changes accelerate.
So we're talking a lot about financial restructuring. I'm curious about the operational restructuring as well, because you're a turnaround specialist. At what point in a company's struggles do you enter the picture? Is it in the 6th inning, in the 8th inning, in extra innings?
Well, it depends. You know, if they're smart, they hire us, when the game's half over, right? Not when we're in the 8th or 9th inning. You know, for example, Tailored Brands, which is the parent company of the Men's Warehouse and Joseph A. Banks. We were hired at the very beginning of COVID, and the CEO basically decided that it was going to be restructuring under cover of COVID. COVID was going to mess with their earnings anyway. It was going to make everything look terrible. So why not take the big, bold moves to operationally restructure the company then? when we really had a chance to do it because everything was disrupted anyway.
Right. And
Right?
you had room to maneuver as well. What are some things that you, as a turnaround specialist, no turnaround specialist can fix or salvage that you just have to say, we have to cut our losses there?
Well, if you've dug the company into such a ditch that to restore the inventory levels or restore the liquidity of the company, you need several $100 million and all of your assets are fully pledged, you have very little chance of surviving. You know, retailers, because the lending environment, they lend to liquidation value, and liquidation value is fairly well known. We're all familiar with the yellow and red, going out of business, you know, sale signs, right, store closing signs. Well, that reflects a lender really assessing what that liquidation sale will bring and lending right to the edge of that.
I see.
And so when you've been lent to right to the edge of it, when you need more capital, it's nowhere to go.
A lot of questions about economic conditions right now. I know you're scheduled to be on a panel at the Bloomberg, the Brink conference a little bit later today here. Do you anticipate that we're going to see more folks in this space struggle, and more importantly, more folks that actually need, if not a turnaround specialist like yourself, maybe a bankruptcy lawyer?
Yes.
Yeah. And you think it's going to be
we're
severe?
going to see an uptick. I don't think it's going to be severe, but I think we're going to see a significant uptick from what we've seen the last couple of years. You know, people came out of COVID, they had levered. COVID from retailers wasn't as bad as many thought it would be, and they had a nice bounce back in 21, and so they really weren't looking at being out of cash. However, now the economy continues to move forward with that consumer.